Welcome to Econlocast, where we break down the biggest stories shaping global and urban economics. I'm your host, Dr. Sarah Lane. Today, we unpack a topic stirring controversy in Washington and Wall Street: President Trump's push to influence the U.S. Federal Reserve, and what it means for economic planning, inflation, and financial stability. Joining us is Dr. GM, a senior urban economist and macroeconomic policy expert. Dr. GM, welcome back.
Thank you, Dr. Lane. Always a pleasure to be here.
Dr. GM, let's begin with the core issue. President Trump has openly called for the Fed to cut interest rates and even criticized the cost of its headquarters renovation. How significant is this political pressure?
It's deeply consequential. The Federal Reserve has long prided itself on independence from political cycles. Trump's overt demands for rate cuts risk what economists call fiscal dominance, where monetary policy starts serving fiscal needs, like cheaper government borrowing, rather than its legal mandate, price stability and full employment.
And what does history suggest about the effects of such interference?
Empirical research, like the seminal work by Cukierman, Webb, and Nyapti, 1992, shows a clear trend. Countries with politically subservient central banks tend to face higher inflation and more output volatility. Markets perceive higher risk, price in uncertainty, and raise the cost of capital across the board.
A more recent twist is the idea of appointing a so-called shadow chair, even while Powell remains in office. What's going on here?
The proposal, reportedly backed by hedge fund executive Scott Bessent, is essentially an attempt to install a parallel authority figure who aligns with Trump's views, particularly on interest rates. This undermines the Fed's forward guidance, which depends on clarity and credibility about future policy direction.
So what's the risk if two policy narratives emerge?
Markets could become confused about the true stance of U.S. monetary policy. That uncertainty raises term premia, the extra yield investors demand for holding long-term bonds, which tightens credit and disrupts the monetary transmission mechanism. It's a destabilizing signal, both domestically and globally.
But isn't the Federal Open Market Committee, FOMC, designed to resist exactly this kind of interference?
Correct. The FOMC consists of 7 governors and 5 regional Fed presidents who vote on monetary policy. Importantly, the chair doesn't dictate outcomes unilaterally. Recent meeting minutes show that the majority of members remain committed to data-driven decision-making, especially on inflation. No, he cannot. Fed governors serve staggered 14-year terms, and their removal is highly constrained by law. Powell's term as chair expires in 2026. Until then, any realignment of policy would require either vacancies or Senate-confirmed appointments, both of which take time.
Let's talk about the urban economy. How does a politicized Fed affect cities and public investment?
Excellent question. If inflation expectations rise due to perceived Fed compromise, municipal borrowing costs increase. This is already reflected in surveys like the University of Michigan's Inflation Expectations Index. Higher long-term yields translate into steeper yield curves, making it more expensive for cities to issue bonds for infrastructure, transit, and housing. Urban planners may find that essential projects get delayed or downsized due to financing constraints.
So central bank credibility is not just a macroeconomic concern. It's a development issue?
Absolutely. An independent, credible Fed helps anchor expectations and maintain low, stable borrowing costs. That stability underpins everything from school construction to broadband expansion, particularly in under-resourced urban and semi-urban areas. As we close, what's your final message on this unfolding situation? In the short run, legal and institutional safeguards offer some protection. Chair Powell has reaffirmed the Fed's independence, and the system's checks and balances remain intact. But the longer-term damage lies in normalization of political encroachment. Economists, planners, and policymakers must remain vigilant. Preserving the Fed's autonomy isn't just a technocratic ideal, it's fundamental to financing sustainable economic development, especially in our cities.
Thank you, Dr. GM, for this critical and timely insight.
Thank you, Dr. Lane. Always a pleasure to share perspectives on these essential issues.
That's all for today's episode. If you found this discussion helpful, do like, subscribe, and share it with fellow economics professionals and students. Stay informed, stay analytical, And until next time, I'm Dr. Sarah Lane, signing off from Econlocast. For references and further reading, see the description box below.